All right, let's jump into a deep dive on something I'm sure is on a lot of our minds these days. Smart investing and making those retirement funds last.
Yeah, two big topics for sure. And especially with the economy being a bit shaky lately, I think it's a good time to really dig into how to make your money work best for you.
Absolutely. We've got some really interesting research here that focuses on conservative investing and how to navigate those market ups and downs, especially when you're thinking about retirement.
Yeah, it could be a little intimidating trying to figure it all out.
Well, that's what we're here for. We're going to break it down, make it easy to understand, and hopefully give you some actionable takeaways.
I like that. Actionable takeaways. Let's do it.
Okay, so the first thing that caught my eye in the research was this concept of an asset allocator fund. Have you heard about this?
Oh, yeah. It's been gaining a lot of traction lately, especially among people who are a little more cautious with their investments.
So basically, it's a fund that kind of automatically adjusts how much risk it's taking based on what the market's doing.
Right, exactly. It's like having a built-in safety net.
But how does it actually work? Does it have like a tiny little person in there watching the stock ticker and making trades?
Haha, that'd be amazing. But no. It's actually all about algorithms and these really complex formulas.
Ah, so like a robot advisor.
You could think of it like that, yeah. It's constantly analyzing things like economic indicators, interest rates, market trends, all that kind of stuff.
Okay, so let me see if I understand. If the market's doing well, the fund is going to be more heavily invested in stocks to try to ride that wave up. But when things start looking a little dicey,
It pulls back, reduces the exposure to stocks, and shifts more into safer bets like bonds.
so it's like automatically trying to buy low and sell high, like the old
Yeah.
saying goes.
Yeah, that's the idea. It's all about trying to minimize losses during those inevitable market dips.
You know, we actually have a graph in the research that shows this in action. Back in March 2020, when the pandemic hit and the market just went crazy.
Right, everybody remembers that one.
Well, this particular fund dropped its equity exposure down to 29%. I mean, that's pretty drastic.
It is, but that's the whole point. It's trying to protect you when things get really volatile. For someone who's conservative and maybe a little bit nervous about losing money, this approach can be really appealing.
Okay, I get it. But I'm also wondering about the flip side. If it's always pulling back from stocks when things look bad, wouldn't it also miss out on some of those gains when the market bounces back quickly?
That's a good question. And yeah, that is one of the trade-offs to consider.
It's like, is playing it safe? Maybe too safe.
In a way, yes. These funds aren't designed to shoot for the moon. They're more about consistent, steady growth over the long haul. It's like the tortoise and the hare, you know? Slow and steady often wins the race.
Which brings us perfectly to our next topic, making those retirement funds last. I mean, most of us are hoping to have a nice nest egg to draw from each month during retirement. But how do you make sure that money actually lasts, especially when the market goes up and down, up and down?
It all comes down to having a solid strategy and understanding the concept of systematic withdrawals.
Systematic withdrawals. That sounds a little scary.
It's not scary. It's actually quite simple. It's just the process of taking out a fixed amount from your savings every month to live on. But you're right, it's not as simple as it sounds.
Because the market doesn't always cooperate.
Exactly. It has its ups and downs, and some of those downs can last a while. Like one of the research pieces highlights market cycles and returns. There was a period between June 2014 and December 2016.
Oh, yeah, I remember looking at that. The Nifty 50 TRI had a return of just 2.37% over those 2.5 years.
Exactly. So if you were relying on your savings during a time like that and taking out the same amount each month,
You could really drain your account pretty quickly. Right?
that's the risk. And that's why having a diversified portfolio that can handle those market fluctuations is so important. You know, that's where this asset allocator fund strategy might actually be a good fit for some people.
So if it's adjusting to those market conditions, it could potentially help to smooth out some of those bumps in the road, so to speak.
Potentially, yes. Of course, it's not a guaranteed thing, but it's something to consider.
Right. Like you said earlier, there's no magic bullet.
Nope. But there are definitely ways to manage risk and feel more confident about your investments.
So if I'm someone who's a bit risk averse, maybe especially thinking about retirement, these asset allocator funds sound like they could be worth exploring.
Yeah, I think so. They're not right for everyone, of course. But if you're prioritizing protecting your capital and you're looking for steady growth, they could be a good fit.
This has been a really insightful deep dive.
It has. There's a lot to think about here.
So for our listeners who are maybe just starting to think about investing or feeling a little overwhelmed by it all,
Mm-hmm.
what would you say are the most important takeaways?
Well, first of all, I think it's really important to remember that everyone's financial situation and risk tolerance are different. What works for one person might not work for another. There's no one-size-fits-all solution.
That makes sense.
Yeah. And I think the second takeaway is that you don't have to be a financial expert to make smart decisions about your money. There are resources available, like these asset allocator funds, that can help take some of the guesswork out of it. But even with those tools, it's still really important to do your research, understand how they work, and make sure they align with your goals and your risk tolerance. And finally, don't be afraid to ask for help. Talk to a financial advisor, talk to someone you trust who understands this stuff. Getting personalized advice can make a huge difference in your financial well-being.
Absolutely. Knowing your own risk tolerance and having a solid plan are arguably the most valuable assets for any investor, especially when it comes to retirement.
Couldn't agree more. And this deep dive is just a starting point. Keep learning, keep exploring, and don't hesitate to reach out for help when you need it.
Thanks for joining us for this deep dive. I hope this conversation helped you gain some clarity and confidence when it comes to investing and planning for retirement.
Thanks for having me. It's been fun. Remember, your financial future is in your hands, so take control, make informed decisions, and build the future you want.
Great advice. We'll be back soon with another deep dive on a topic that matters to you. Until then, keep learning, keep growing, and keep investing in yourself and your future.
See you then.